All right, I see that the attendees are coming in. I think we'll go ahead and get started. Hi, everyone. My name is Samir Varma. I'm a partner in Thompson Hine's International Trade Group. Welcome to today's SmarTrade Fundamentals webinar on export controls. For those of you who don't know, this is the final session in a four-part series focusing on the basics of international trade regulations. And during our series of webinars, we've walked through the fundamentals and provided practical tips for dealing with day-to-day issues. The prior sessions focus on economic sanctions and customs, as well as import and other trade policy issues. And if you are unable to attend any of those sessions, go ahead and contact us, and we can provide you with those sessions as well. Our goal for this series has been to help both seasoned and beginning compliance professionals refresh their knowledge about the essentials of trade compliance. But before we begin, I do need to go over a few housekeeping items. Today's program is being recorded. We will send a link to all the attendees within 48 hours of today's presentation. The presentation is intended for the general information of individuals and organizations on the matters of current interest. The thoughts, opinions being expressed today are those of the individual panel members and do not necessarily reflect the opinions of the panel members' clients, employers, affiliates, or Thompson Hine. The content should not be taken as advice, and the views expressed are for informational purposes only. Good disclaimer there, a lawyer disclaimer there. If you have any questions during the webinar, feel free to use the question box located on your screen. It's on the control panel on the right side, and submit questions that way. We'll answer as many questions as we can, both during the presentation and at the end of the webinar. And if we don't get to your questions, we'll follow up after the program, either by email or by phone. We will be offering CLE credit for today's webinar, so please be sure to complete the verification of attendance survey. A link to the survey is also included in the agenda that can be found in the handout section of the control panel located on the right side of your screen. We will also paste the link in the chat at the end of the program, and I will announce the tracking code at the end of the program. In the handout panel, you can also download a copy of today's PowerPoint slides, as well as bios of today's speakers. On that note, today I am joined by my colleague, Aaron Mandelbaum. Aaron is an associate in our international trade group and will be leading the discussion today on export controls. I, like many of you on the call, will be acting as an attendee as we watch Aaron and his enthusiasm for export controls show throughout today's webinar. Aaron, go ahead, take it away.
All right. Well, thank you so much for that introduction. Good afternoon, everyone. As Samir noted, my name is Aaron Mandelbaum. I'm an associate here in the International Trade Practice Group at Thompson Hine. I'm very excited to be here today to present to you the fundamentals of export controls. Frankly, we have a lot of ground to cover, so I say we just jump right into it. So this slide will show you kind of a roadmap of what we're going to do today. We're going to start by defining what export controls are, and then we're going to answer why countries impose them in the first place. We're next going to turn to the bulk of this presentation, which is asking ourselves, well, can I export this? And as we can see on the screen, it's a multi-step process that will actually vary depending on the export control regulations. After that, we'll then highlight a few red flags that an export transaction can pose, and then we'll turn to some penalties, God forbid, those are actually violated. And then finally, we'll conclude with some recent trends. I think that's really important because in addition to trying to provide you some fluency in the basics of export controls, you can also get a sense as to what's driving the conversation among practitioners in the field today. And importantly, that can help you answer the question of how export controls impact you and your business. And I can't think of a better way to transition to the next slide. How do export controls impact you and your business? Now, frankly, what I've provided on the screen for you isn't super surprising. Of course, export controls are going to disrupt supply chains. It could result in major financial penalties, other types of restrictions and limitations, of course, reputational harm. But I think what export controls, what makes it so tricky and challenging is just this pace in which they are constantly being rolled out. I would describe them as swift. I'm sure many people on this call would actually call it frenetic. But the point that I really want to emphasize here is that we have kind of restrictions on goods, technology, and services coming out on a near weekly basis, right? And at the same time, these can often curtail business opportunities with certain markets. And as well, they can also open up your transactions to governmental scrutiny by regulators, which is like the scariest sentence in the English language for a company, right? But along those lines, it probably also doesn't help that the boundaries of what goods are controlled under US export control laws are often being blurred. The industries that are kind of designated as critical to national security is a constantly growing list. And of course, an undertone to all of this is that export controls are increasingly rolled out on a multilateral basis, right? So given this layout, it's quite clear that export controls impact you and your business quite intimately and quite extensively. So naturally, this all begs the question, what are export controls? And export controls refers to the collective body of laws, regulations, and rules regulating the export, re-export, and transfer of goods, software, and technology, what we collectively refer to as items, based on the end destination, the end user, and the end use of the item. Now, I promise you, we will be returning to this definition throughout the presentation. We're actually going to break it down clause by clause because this simple sentence is actually packed and layered with complexity. But before we return to it, I first want to just discuss why countries even have export controls in the first place. Why do we even have them? And the answer is that export controls are a necessary tool of economic statecraft, right? So these are countermeasures in response to geopolitical events that are considered ideal for protecting national security interests and promoting foreign policy priorities. Export controls, though, are one tool in this toolbox, though. So for example, there's also foreign investment review. So for those of you out there that are familiar with the Committee of Foreign Investment in the United States, or CFIUS, that's what that is. Supply chain rules, so that would be like the Uyghur Forced Labor Prevention Act, the UFLPA. Arguably that would also be like trade remedies, which we covered in session 3 of this 4-part webinar series. And there is one in particular other than export controls that I briefly want to touch upon, which is economic sanctions. Just to be clear, we did cover economic sanctions in the first part of this 4-part webinar series. So if you need a little refresher, I highly recommend checking that out again. But it's worth noting that economic sanctions and export controls have a lot of crossover. And as a result, it prompts a lot of confusion. So I just want to kind of quickly discuss economic sanctions are all about curbing certain dealings, certain types of transactions with specific governments, industrial sectors, malign actors, whereas export controls, as we now know from our definition, is all about regulating the movement of items, again, based on their end destination, end user, and end use. So let's actually return to our definition of export controls. And like I said, we're now going to spend a good chunk of the rest of the presentation just breaking this down clause by clause. Now, admittedly, we're not going to go perfectly sequentially. I'm sorry in advance, but we will mostly go in order. So let's break this down and let's start at the very beginning, the laws and the regulations. So in US export control law, export controls rather, there are 2 primary laws, 2 primary implementing statutes. The first is the Arms Export Control Act, which implements the International Traffic in Arms Regulations. And the second is the Export Administration Act of 1979. That's going to implement the Export Administration Regulations. It's worth noting that there are a wide variety of other laws that will implement export controls, and realistically, most export controls are actually espoused in the regulations. So I think it's actually worth pointing out what those are. So on your screen, I have now identified for you just a handful of export control regulations. Truth be told, this is actually just a very short list that I could find just through a very simple internet search because there are so many out there. So these are just the first ones that came to my mind with the aid of Google. And it's worth noting that you can see how they vary, not only based on the products, but also kind of what agency or department is going to take regulatory authority over those controls. But as mentioned earlier, or at least referenced earlier, we are going to spend our presentation really focusing on 2 in particular. So that would be the Export Administration Regulations, and the second would be the International Traffic in Arms Regulations. So now that we know what the export control laws and regulations are, it begs the question, can I export this? And naturally, a lot of you are probably thinking, well, what is this? And to that, we can just turn to our handy dandy definition. And it's actually right there, staring right back at us. It is the goods, software, and technology, collectively what we call items. And while we tried to ask ourselves, well, can I export this item? We first need to ask ourselves, what is this item? And in doing so, as we engage on this export control analysis, you'll see that this first question is actually a first question in a series of 7 questions that will get us to the finish line here, right? And answering these 7 questions will really ensure compliance with US export controls. So let's, again, kind of proceed on with our first question, which is, what are you exporting, right? Now, we do recognize that this is going to prompt us to ask ourselves, well, is the item a good? Is it a service, a software, a technology? But another way of looking at an item is, what type of item is it? And in the world of export controls, there are 2 primary types of export items, right? So the first type are military items. So these are defense articles and defense services. Do not worry, we will define these terms later, but you can basically think of a military item as kind of anything that, think Defense Department, right? The other type of item are what's called dual use items. So these are items with commercial and military or nuclear proliferation application, right? So think kind of civilian items, but on second thought, maybe the civilian item could be repurposed for a military need. So that would be a dual use item. Okay. Once we figure out what type of item it is, if you recall, the second question is, well, who has jurisdiction, right? What US agency has jurisdiction over the item? Jurisdiction is just a fancy legal term to mean who has the ability to administer and enforce the regulations over this item. As we saw earlier, there are a lot of different agencies involved. So that is, it's a challenging question, but the truth is that in export controls, there's really 2 primary authorities. The first is the International Traffic in Arms Regulations mentioned earlier, commonly referred to as ITAR. It is administered and enforced by the Directorate of Defense Trade Controls, or DDTC, within the US State Department. That regulates the defense articles and defense services. The second is the Export Administration Regulations, or the EAR. And that's what regulates over dual use items. And those regulations are administered and enforced by the Bureau of Industry and Security, or BIS, at the Commerce Department. Now, it's worth noting that whenever you are undergoing an export control analysis pursuant to either regulatory regime, you're still going to ask yourself these 7 questions, right? So in that sense, it is pretty straightforward. I think what becomes a challenge, though, is that ITAR, by its nature, is more exclusive. It only pertains to military items. And as a result, this chain of questions actually can kind of be curtailed down to a 4-parters, because DDCC doesn't necessarily care where you're sending your item, who's going to get it, and what it is. They just want to know, okay, we have jurisdiction. Do they need a license or not? So it's a pretty kind of shortened process. But while we're talking about ITAR, it's kind of important to ask yourselves, well, what exactly is covered by ITAR? Or as we commonly say, what is subject to the ITAR, right? So to answer that question, first off, this slide just kind of starts off by noting it's a narrow class of items. So in an export control analysis, you want to start with the ITAR before you move on to the EAR. It's also worth noting, by the way, that items can only be regulated by one of the 2 regulatory regimes. So it's either or, it's mutually exclusive. An item can't be regulated by both. But the ITAR covers defense articles. So these are items listed on the US munitions list, or the USML. We will come back to that. Also defense services. So that's furnishing assistance to foreign persons related to items on the USML. There are a wide variety of activities that are covered here. I've actually just listed a few of them. Nothing, I don't think, super surprising: the design, the manufacture, the operation, etc. And then finally, technical data, right? So this is information necessary to the design, the development, the repair, etc. of items on the USML. So a good example here are, formulas, bills of material, blueprints, instructions. You get the idea. So that begs the question then, well, how is the ITAR classified? And we've noted earlier that it's the USML, and it's worth noting that defense articles and services are listed in 21 different categories on the USML. I don't think any of these are super kind of surprises, super surprising, I should say. Firearms, right? Like vessels of war, it's in the name, aircraft, submersibles. But you could be looking at this list and saying, okay, I think I have a defense article. I don't think it fits neatly in category 21, the kind of miscellaneous. So how can I really confirm that my item is going to be captured by the ITAR? And hey, when in doubt, you could always submit a commodity jurisdiction request to DDTC. It's something that we here at Thompson Hine do like all the time. So by all means, there are definitely ways to make sure that your item is properly classified. It is worth noting, though, that the ITAR actually has two significant quirks. The first quirk is this concept of registration. So you do need to register with DDTC if you are a manufacturer, an exporter, or a broker of defense articles, services, and technical data. It's a pretty straightforward process. You're basically going to tell DDC who you are, information about your company, like its ownership structure, any possible affiliates and subsidiaries, stuff like that. You do have to pay an annual fee, so bear that in mind. But that's kind of the first quirk. The second quirk is by far the quirkier of the two, and that is what's called the see-through rule. It is so quirky that it's actually not even in the ITAR. It's an unwritten DDTC rule, so do bear that in mind. Effectively, what the see-through rule says, or kind of espouses, is that if you have an ITAR-controlled part or component, and then it is subsequently incorporated into a larger item, doesn't matter if it's in the United States or abroad where that incorporation takes place, that item the entire item will become subject to the ITAR. So that in a nutshell is the type of items that are subject to the ITAR. That certainly begs the question then, okay, well, what types of items then are going to be subject to the EAR? And in that sense, the EAR roughly covers kind of four major categories of items. The first are items that are in the United States or even moving in transit through the United States. So if you have a shipment of goods coming from, say, Japan, and it's being sent through the United States and it's going to end up in Europe somewhere, be it by virtue of moving through the United States, those items are now going to be subject to the EAR. The second set of items that are subject to the EAR are US origin items, no matter where in the world they're located. The third set of category are foreign produced items, foreign origin items, no matter where in the world they are, when they're made with more than a de minimis, more than a minimal amount of controlled US origin content. It's worth noting that there are a few different de minimis thresholds in the EAR regulations, but there are kind of two big ones that are worth noting. The first is the 10% threshold, hence why it's sometimes referred to as the 10% rule. And that basically says that if 10% of this item contains US origin content, it will be covered by the EAR. 10% is a pretty low bar, so as you can imagine, the countries that are designated for having their items subject to the EAR are going to be ones that the US government has some issues with, let's say. So that would be like, Iran, Cuba, North Korea, Syria. And then the other threshold amount is 25%. More or less kind of applies to basically any other country. So if 25% of the item has US origin content, even though it was foreign produced, it'll be subject to the EAR. The final set of category of items that are subject to the EAR are foreign produced items as well, but this time these are items that were clearly the direct result of US origin technology or software, no matter where in the world those items are located. This fourth bullet point is really a reference to the foreign direct product rules, the FDP rules in the EAR. So now the EAR has that, as a result, pretty broad category of items that it covers. And a lot of these items are listed in what's called the Commerce Control List, the CCL. And items are actually classified by their Export Control Classification Number, or their ECCN. It's a pretty long alphanumeric code, but it is worth noting that the first digit in that code is a reference to the type of category the item belongs to. And then the second letter, the second digit, the first letter in that code is the item's product group. So it can be kind of confusing, but it's okay if an item doesn't necessarily have an ECCN. Some items just aren't on the Commerce Control List. And in those situations, they're still subject to the EAR, but even though they're not captured by the CCL, they're going to be designated EAR 99, right? These are, in general, low-level technology consumer goods, and often, but not always, will not require a license, okay? So this will also kind of, I think, beg the question then, like, okay, well, where do I find or get an ECCN? And there are kind of three main ways. The first is you could just ask the manufacturer, right? You can check their website, you can talk to them if you have that relationship. I hope you do. The second way, though, is the supplier. That's a great way when it's reasonable to do so. And then the third way is you could just ask BIS directly. You could do that via a classification request. It's pretty comparable to the commodity jurisdiction request that you would send to DDTC for, your military item. I would be remiss not to mention that Thompson Hine submits classification requests all the time. We're very familiar with this, so I guess there's a fourth way. You could ask us too. We'll be more than happy to help you. Now, let's return to this export controls definition, because we've kind of talked about the laws and the regulations. We've talked about what items are going to be kind of controlled by US export controls. But I think it's worth noting, well, what exactly does it mean to export, re-export, and transfer? I'm going to pause there really quickly. Samir?
Yeah, let me ask you a question. I mean, I think maybe you should talk, I know we talked a little bit just now about items that are subject to, items are either subject to ITAR or subject to the EAR. Not both, those are mutually exclusive. But maybe you can give some examples of items that I guess are not subject to EAR or ITAR.
Yeah, so there are definitely a subset of items that are not subject to the EAR. I think because that's not as restrictive as the ITAR, it's probably worth just discussing it from that vantage point. So items that convey information. So think of like books, newspapers, periodicals, right? Calendars. These are items that would not be subject to the EAR. So there definitely are items that are not going to be captured by the regulations, but these items are kind of few and far between. So just bear that in mind. Now, I have inadvertently clicked on my screen so you can kind of see what's coming next, which is we're now going to kind of talk about, well, what does it actually mean to export, to re-export, and transfer? I do realize that some of you out there probably know exactly what this means, but it can be kind of tricky. So just bear with me here. So let's start with what an export is. An export is a shipment or transmission of goods, software, or technology outside the United States, even temporarily. That seems to trip up a lot of people, so do bear that in mind. It's also worth noting, though, I think that an export kind of has this connotation that it is privy to a transaction, but that's not always the case. An export doesn't necessarily have to be a sale. So for example, providing samples, donating something, gifts, these would be examples of an export, even though there isn't necessarily a transaction taking place. Also, I should point out that, an export can, in limited circumstances, be performing a certain type of service for the benefit of a foreign national, but it kind of depends on governing regulations. So just kind of maybe put that on the back burner. Now, I also should point out that there is a concept. Yeah.
We have a couple questions from some of the attendees, and so I thought before you moved on too far. One of the questions is about de minimis, actually, the de minimis thresholds, and basically just how that percentage is calculated, and the question is, can you share some guidance on how the percent would be calculated regarding the 10% or 25% rules?
Yeah, so great question. I would say kind of it's a two-part answer. The first part is there are broadly speaking kind of three de minimis thresholds that I've encountered, really 0, 10, and 25. You do want to look at the foreign country where the item is being produced. That's going to be kind of the crux of your analysis there. But the other kind of second part of the answer is actually it's in the EAR. There's a supplement to one of the parts of the EAR, and it actually breaks down how BIS calculates and how you can calculate the de minimis threshold of your item. So there is a kind of a prescribed method to the madness.
Yeah, and I think that the key there, I mean, is that the 10%, 25, or 0%, 10%, and 25% thresholds really do vary depending on sort of the item. The idea is also that it has to be sort of controlled content, right? It's not just the sort of US content, it is the controlled content. So if you have an item, and I think that the question sort of asks a little more depending on sort of weight and volume and function and how it could lead to different results. And that is very true, but I think it really depends on what you're doing with certain chemicals or certain items or certain physical items or things like that. It could vary. And I think that the guidance document does talk about it a little more. And if, because it's such a sort of specific question, we're also happy to talk about with the person who asked the question sort of offline or off the webinar, but I think we can get into a little more of the specifics there as well.
Yeah. All right. So just kind of pick up right where we left off. And actually, we can kind of use this slide as a great jumping point. So we talked about what an export is. We also note that it's not always a sale. You'll notice one of the items that I list there is deemed exports. So there is this concept of deemed exports, which beautifully transitions to our next slide, which is a deemed export is the release or disclosure of technology to a foreign national within the United States, right? And it's worth noting that a release, it could be oral, so like a conference call. It could be visual, like a factory tour. It could also be electronic, a simple email. That would constitute a type of release that BIS will consider to be an export or deem it an export. So there you go. So that's what exports and deemed exports are. You'll recall in our definition, we also have the concept of re-exports. Now, re-exports are more or less the same thing, but this time around, you're sending your item to one country that is actually the intermediary country. And then it's going to continue on to yet another foreign country, the ultimate end destination. Now, some of you out there might be like, well, wait a minute. I thought that the EIR would only cover my transaction from me to someone else. But now you're telling me that it's going to possibly continue on and cover even more of my transaction to yet another foreign country. That seems odd. You would be right. Re-exports, by their very nature, are an extraterritorial application of US export controls. So do bear that in mind. It's also worth noting that we had exports and deemed exports. We have re-exports. Do we have deemed re-exports? You bet we do. We also have deemed re-exports. These are the release of technology or software in a foreign country, but this time it's going to a third country national. Now, I'd also like to point out that in our definition, we talked about exports, re-exports, and transfers. A transfer is basically when there's a change in the end user. More often, that's what it is, but it could also be referring to a change in the end use of the item, all within the same foreign country. I want to highlight one more thing because it trips up a lot of people, especially beginners. It got me, okay? Which is basically a transfer in country is the same as an in-country transfer. These terms are synonymous with each other. There's no rhyme or reason why BIS might refer to a transfer one way or another. They're never kind of grouped together. So do bear that in mind. It can confuse people. Now, I want to point out before we just kind of move on with kind of breaking down our definition, I realize that we've kind of defined these terms. You probably understand it now in the abstract, but you could be like me, where you're a visual learner and therefore seeing what these activities refer to can be extremely beneficial to your understanding of what they are. So the next few slides are going to illustrate just that. So what is an export? We have A, who is a national of country 1, and B, who is a national of country 2. I don't think this one will be too surprising for you out there. A to B, right? That is going to be an export. That's what an export looks like. All right, so what about a deemed export then? So in this scenario, we talked about earlier how it happens within the same country. So let's say B moves to country 1. I don't know, B got married, they got a new job. For whatever reason, they're now in country 1. If A is going to share technology or software with B, and again, B has never relinquished their nationality when it comes to country 2 nationality-wise, A to B, that's what a deemed export looks like. Okay, let's send B home and move on to what a re-export looks like. And we talked earlier how a re-export is an export, but it involves a third country. We talked about an intermediary country and then an ultimate end destination. So this time we're going to introduce C, and C is going to be a national of country 3. So A to B, that's your export, and B to C, that is the re-export that's happening. So B to C is the re-export. Now note, this also clearly demonstrates that a single export, or I should say like export activity or transaction, could be comprised of multiple types of exports. So one re-export is going to involve one export and one re-export. So just keep that in mind when you talk about re-exports. Now, let's get rid of all of this and move on to what is a deemed re-export. So it's similar to the deemed export. This time C is going to move into country number 2. Again, I don't know why, maybe C got married there, maybe they got a new job. A to B, that's your export. B to C, that is your deemed re-export. So that's what that looks like. Now, we're going to get rid of all this and conclude with what is a transfer. So a transfer we talked about is happening within the same country. So we actually don't really need to worry too much about country 2 anymore. We can kind of put that to the side, but we do need to introduce a friend for A. So we're now going to call A A1, and we're going to give him a friend A2. When A1 discloses, or shares some sort of good or service or technology with A2, that's going to be an in-country transfer. It's worth noting, though, that country 1, by definition, cannot be the United States, because an American providing a good or service or technology to another American is not an export. So do bear that in mind, that is not the United States. Okay, we're going to move on. We're going to return to our definition now. And, oh, I'm sorry, one more thing. We should also note that a lot of this conversation is predicated on the concept of nationality, right? So for all my people listening out there, as opposed to you businesses, a natural person, an individual, is a foreign national of, and it actually varies by the regulations. So under the Itar, it's any and every country in which a foreign person has held or holds citizenship or permanent residency. In other words, under the Itar, an individual can have multiple nationalities. That's very different than the EAR, in which case only the most recent country of citizenship or permanent residency is that individual's nationality. This is actually really helpful because it also indicates that the inverse is true, right? So a foreign national is not a US citizen. It is not a lawful permanent resident, which we refer to as a green card holder in the United States. And it's not a certain statutorily protected individual as defined by statute. It's a very kind of narrow statute, so it's there, but it doesn't typically come up. Okay, let's come back to our definition. We've talked about laws and regulations. We've talked about the items. We've talked about what it actually means to export, re-export, and transfer. Let's move on to the next part, which is the end destination, because that will kind of dictate how items will be governed under export controls. So what you want to do is you found your item on the CCL, and what you want to do next is you want to then cross-reference it with the Commerce Country Chart, the CCC. There's a lot of alphabet soup in export controls I'm sure you're picking up right now. Now, this is the third question in our 7-part question, a series of questions to determine if we can export something. And I want to point out that the image on the right-hand side of your screen really is what the Commerce Country Chart looks like. This is a screenshot from the cover page. You can see actually on the left-hand side, the rows are filtered by the end destinations. And what you're going to do is you're going to figure out where you're sending your product to, and then look in the corresponding column if there's an X. The columns refer to the reasons for control. You need to figure out why your item is controlled. If there's an X, there's a reason. If there's no X, there's no reason. Now, you can see there are 8 reasons for control. I've listed about half of them, exactly half of them on the screen. They all have cute little nicknames, but there's, for example, nuclear proliferation, missile technology. It's worth noting that these are actually pretty broad. You see national security, you see regional stability. So do bear in mind that no matter how you might think of an item, you might not think it, might destabilize a region. BIS might disagree. So just, keep that in mind. I think naturally, though, this kind of provokes the question, okay, well, are there certain places I just really need to be wary of? For example, places I just cannot do business with. And the answer is yes. The United States does maintain comprehensive sanctions, or colloquially what we call an embargo, against 4 countries in particular. That would be Cuba, Iran, North Korea, and Syria. But I want to also highlight that, as this slide is named, it's places of concern, not countries, because there are a few places that you also need to be mindful of. These actually probably won't be super surprising given current events. With Russia's full-scale invasion of Ukraine, you do need to be cautious. You cannot send items to eastern regions of Ukraine. So that would be, Crimea, Donetsk, and Luhansk. But of course, there are still other places where, yeah, you're not necessarily outright prohibited from transacting with, but there are significant limitations and restrictions in place. This is not a comprehensive list, but on the slide, you can now see I've listed a few in particular. I don't think any of them are going to be super surprising. Belarus, China, Russia, Venezuela for sure. So, keep that in mind when you're determining, okay, well, I have my item. I know who has jurisdiction over it. Where exactly am I sending it to? So let's go back to our definition. We're just going to keep on strolling along. The next clause that I want to break down for you is the end user. So under US export controls, we do need to be mindful about who is going to receive the item. And in that sense, every party to a transaction must be checked, or as we call it in the business, screened, again, to make sure that they're not some denied or restricted party. I always find that this is an excellent opportunity to consider the nationalities of the people involved in the export activities. And for simplicity's sake, I'm going to kind of bring back an illustration we mentioned earlier. So again, on the screen, we have a very simple export, A to B, A from country 1, A to country 1, B in country 2. So of course, if you're A, you want to screen B. But what if you have a third party involved? So maybe that would be D. And I don't know, let's say D is like a third party reseller, right? You would very much want to screen D too. You don't necessarily want it to just kind of only focus on the ultimate end user. Now, when I say you want to screen these people to make sure that they're not denied or restricted, I should point out that I'm using the term people in kind of the legal sense, not necessarily the way that we casually throw out the word. So a person under US law, a natural person is a human being, a legal person is an entity. So you would want to check these people against prescribed party lists. These are lists maintained by the US government that highlight, who's denied and who's restricted. I've listed just a handful on the screen. This is certainly not a comprehensive list of the prescribed parties, but there is one in particular that I do want to kind of quickly touch upon. It's the SDN list, the specially designated national and blocked person list that is maintained by the Department of the Treasury's Office of Foreign Assets Control. This is an example where economic sanctions crosses over with export controls and as a result causes confusion. But I don't want to go into too much detail. The only reason I wanted to mention this actually is because we discussed this at length in the first session of this 4-part webinar series. So again, if you're kind of having some kind of doubts about it, an excellent opportunity to go back and kind of learn more about the SDN list. Now, we're going to just kind of meander on, and we're going to go to the last clause in this sentence, which is the end use of the item. So, there are several prohibited or restricted end uses for exported items. We've now moved on to our 5th question in our 7-part question. And these prohibited or restricted end uses shouldn't really be super surprising. I'm just going to highlight one of them in particular, like the chemical and biological weapons. When you think about it, it makes sense that the United States government would be very mindful about other people in other places gaining access to chemical and biological weapons. So you do want to just kind of make sure that whatever it is you're sending over, you want to make sure that it's being sent over for reasonable and legitimate reasons and acceptable reasons at that, not anything that you'd see on the screen, for example. Now, you'll notice as we return back to our definition, there is kind of one thing that I've been jumping over this entire time, and that is the rules. So there are some rules of export controls. This kind of loosely refers to the back 2 questions 6 and 7 in our 7-part question series. And there we go. there's my animation. And we're just going to start with the first one, question 6. Do you need a license? And sometimes the answer is no, you just don't. And that would be referred to as no license required. Now, typically, these are going to be items that don't appear on the CCL, which means they're most likely, that means they would be designated EAR 99. So that would not require a license. The other is when you find your item on the CCL, you cross-reference it on the commerce country chart. If you recall, we talked about how there were X in certain cells. If you don't see an X, then under the corresponding reason for control in the designated destined country, then that also will not require a license. Now, it's worth noting that realistically, most exports from the United States are just not going to require a license. They can be sent out with the NLR designation. Now, sometimes your product or your item that you're going to export does require a license, but for 18 specific reasons, they're actually exempted from the license regime. So these are kind of scattered and broad, so it does require a significant amount of analysis. So for example, you see like, temporary exports, humanitarian, government items. So strategic trade, that kind of refers to US strategic trade partners. So there are some times where the answer is no, but, sorry, sometimes the answer to the question, does my item need a license? The answer is yes, but I can avail myself of a license exception, and as a result, I'm actually in the clear. Now, it's worth noting that sometimes an item, take an EAR 99 item, I think that this is like the best example. It doesn't necessarily require a license, but because you're going to send it to a certain end destination or to a certain end user for a certain end use, you actually will require a license. So a best practice here that we always advise is when you're asking yourself, do I need a license? Just double check. Just always rather be safe than sorry. And if you are fortunate enough to obtain a license, then you should note that licenses, generally speaking, have a 4-year validity period. Okay, so the last question, question 7 in our export control analysis is, what are the management requirements? Yeah.
So a couple more questions we've received from some of the attendees. One of the questions is, my understanding is that services are not in the scope under the EAR. Basically, no, you are correct. Services are not covered under the EAR. They are, however, covered under Itar, under defense services. And so when we talk broadly about export controls, certain services are covered, but there are no services under the EAR. I don't know if you have any follow-up to that, Aaron, but I can just go to the next question. So it's a little bit more of a longer question, but it's appropriate for this portion of your presentation regarding do you need a license. And it provides a little bit of more of a sort of supply chain where the company is based in the United States, purchases product from a sister company in Japan, and so in the US, purchases product from Japan, from Japan is sold to a distributor in the Netherlands, and then in the Netherlands they'll sell to a sanctioned company in Germany, right? So do you need a license? If you want, I can give my thoughts and then have you weigh in. Oh, it says, can we safely sell this way? And the end use is not military. So we're under the we're saying we're under the purview of the EAR. Again, a lot of it is the devil's in the details about the product itself and whether the product has any US content or US controlled content to make it subject to the EAR. Furthermore, whether or not the product ever even comes into US soil, right? The question asked says we are in the US and purchase products, does that mean the product actually came to the US at any point? But once it comes to the US, it is considered a US origin product wherever it goes, and then is subject to the EAR. And even if it doesn't, let's say, come to the EAR, I'm sorry, let's say it doesn't come to the US or is potentially not subject to the EAR, there's still going to be other considerations related to sort of facilitation and evasion, which I think you're going to cover later on in the slides. But so I don't think we can say yes, absolutely you can do this transaction, but certainly the considerations are whether or not it is or is not subject to the EAR, but also what is the US person involved in, not only from an EAR perspective, but also from also from the other evasion and facilitation considerations as well. And there is one more question, which I might as well, I don't know, Aaron, I don't know if you have any other thoughts on that one, but there's also one that says, can we use the consolidated screening list, which likely takes care of the various lists you described? It was covered in our economic sanctions webinar as well, but I mean, the consolidated screening list is sort of the various screening lists that are I think there's 6 or 8 different screening lists based in the United States. The U.S. government has tried to consolidate all those into one area. Often that is used. You know, we often suggest using a more robust sort of software tool or other tools that are available that not only use those U.S. lists, but also various international lists from various countries all over the world. We think that's probably better, not only from just a prohibited or restricted party situation, but also just from a red flag purpose, which I think is.
Yeah, I'll just quickly kind of touch upon that last bit, which is I love the consolidated screening list, but I have 2 issues with it. The first is, in my experience, I find that it's not always immediately updated following a notice in the Federal Register. So sometimes it could be a little outdated, which can be problematic. And then the second is, by its nature, it's really only referring to the prescribed party lists that we maintain, that the United States government maintains. And while you might find no issues there, depending on who you're sending it to, where they're located, other countries involved, you would want to check their denied or restricted parties lists as well. Other countries, the EU also, other regions, I guess, also have their prescribed parties lists. So that's kind of another concern that I have with the consolidated screening list. Even though I like it, I don't want to tear it down, but it is just something to be mindful of. And if it's okay, I'm just going to proceed onward because there are other things that are worth being mindful of, like management requirements. So now, when it comes to management, what the management process is, the regulatory bodies love it when when businesses, I should say, have compliance programs, especially audits. They love internal audits, external audits. That's why I purposely included the word audit on the screen. So when you take this deck home with you, you remember that word. Highly recommend audits. Also, just there are general record keeping provisions in the Itar and the EAR that you should be mindful of. And finally, you do want to make sure that you're complying with other regulations. A perfect example would be the foreign trade regulations, which are maintained and enforced by the Census Bureau, which is in the Department of Commerce. So they are not only counting people once every 10 years, they are very much active, and you need to very much be complying with their regulations in addition to what we're talking about today with export control regulations. Now, out of all of these, I do want to just quickly touch upon the record keeping provisions because I think that is really pertinent to our discussion today. So the first is that under the ITAR and the EAR, actually, the record keeping requirement is the same. You need to keep records for 5 years from the date of transaction and or the relevant activity. Naturally, I'm sure a lot of you are like, well, wait, what's a relevant activity example? That would be acquiring a license. So yeah, maybe you make a transaction or you formalize a transaction on a certain date, but then you realize, well, I also need a license. Once you get that license, you're going to need to keep it on hand in your files for at least 5 years. Now, I also want to point out that a lot of people are probably also asking themselves, what are the records that I need to keep? And the answer is it's basically documentation related to the export activity. So, invoices, purchase orders, license requirement determinations. And why would you want to, comply with this law? Just kind of in general. First off, it shows good faith that you're actually complying with the law, but also it's really beneficial if, God forbid, something bad happens and you can then kind of go back to your records and figure out what went wrong. It helps when you're trying to formulate a defense in the event of any wrongdoing or accusation of wrongdoing. So now let's highlight some red flags that an export transaction could actually, cause. So it's worth noting that under U.S. law, you are required to look for red flags. You cannot just kind of take this willfully blind approach. As a matter of fact, if you don't check for the likelihood of red flags and then your customer subsequently violates the law, you could be held liable, which is a horrifying thought. And now I should also point out that there are a wide variety of red flags. BIS actually has a really great list online, and I've provided the web, URL to that, so you can check it out after this presentation. But I do want to emphasize that a red flag is not necessarily fatal, right? It just means that it requires additional scrutiny. It could render your transaction fatal, but not initially. Now, there are a few different red flags. Like I said, they're listed online, but I do want to highlight for you today because it's just good to be mindful. So the first is when your end user or their address is identical or similar to that of a prescribed party. That is definitely going to raise a red flag. Another would be if the end user has no business background or doesn't typically engage in a business consistent with the item being exported. To use an extreme example, that's like an end user in a landlocked country just for whatever reason trying to import as many aircraft carriers from abroad as possible. Again, that's not necessarily like going to be fatal to saying, oh, well, they don't really handle that, so we can't send it to them. But it's definitely going to raise some eyebrows and is going to require some additional consideration. Another red flag I want to point out is when an individual kind of grossly overpays for something given market rates. Another would be if a freight forwarding firm, an intermediary party by its nature, is listed as a product's end user. That's a really classic red flag example. That admittedly could be a clerical error. So again, it could be something as simple as that, and that's why it would require additional scrutiny. And then finally, there's a weird or abnormal shipping route given the item or the item's end destination. The real concern here is transshipment. And I want to highlight the fact that the U.S. government maintains a list of transshipment points and ports online, something to check out after this presentation. There is one red flag in particular that I do want to emphasize today. That's the red flag of diversion risk. This is a top concern for U.S. export compliance officials. And diversion here is referring to the illegal practice where you send an item to a seemingly legitimate customer, but then they're in turn reselling it to a prohibited end destination, end user, or end use. Again, you have to look for diversion risk. You have to look for all these red flags, but you especially have to look for diversion risk. If you do not do so, the infamous head in the sand approach, that will not fly. You will be very much held liable for illegal diversion. And I think actually while we're on the topic of fear, we should just move on to penalties because that is certainly what keeps a lot of people up at night. We're going to start kind of with the financial penalties and then move to the other kind of categories of penalties. So the first is under the Itar, the civil violation, as we'll see in the next slide with EAR, the civil violations are adjusted annually for inflation, but the Itar one is particularly painful. It is up to $1.2 million or twice the value of the transaction, whichever is greater per violation, not per export, per violation. So that is really, really painful. On top of that, you could also be hit with a criminal violation of $1 million per violation. And also for my natural persons, which we now know what that is, for my natural persons out there who can very much go to jail, you could also be sentenced with a 20-year prison term. The EAR penalties are actually pretty comparable. In this case, the civil violation is just north of $350,000. I put the exact dollar figure on the screen. The criminal violations are actually identical. It's going to end up being $1 million per violation and then 20 years in prison. These are the financial penalties, but rest assured, there are other types of penalties out there. In the United States, to export something is a privilege, not a right. And as a result, you could be denied that privilege either temporarily or permanently. You could be denied it in general or for a certain type of items. So that would be the first type of penalty. Another penalty that you could face is having your goods and vessels seized and forfeited. Another is exclusion from practice. What that means, which is a really big deal for attorneys, is if you're an attorney or even an accountant or kind of anyone else who has business before BIS or Itar, maybe you're applying for a license, or maybe you already have a license, or you have other business, you could be excluded from practicing before the agency, which could really tarnish your ability to practice US export controls and assist people. And businesses. Another is you could be suspended from government contracts. And then finally, there's kind of this odd class of penalties. They're called administrative sanctions. No matter how you dice it, though, they're still pretty painful. The first is you could actually be limited in accessing certain types of license exceptions that anyone else otherwise could. And then the other is if you already have a license, it could be revised, suspended, or revoked. So do be mindful of those as well. Finally, I want to just kind of quickly conclude with recent trends so you know what we are focusing on as practitioners on a more kind of day-to-day basis and what we're seeing in the field right now. So the first kind of recent trend is heftier fines. Actually, in the springtime earlier this year, BIS hit a company with its largest penalty ever in its history with a whopping $300 million, so very painful. Another trend that we're seeing is a crackdown on export control evasion, especially when it involves people from China and Russia. BIS has kind of partnered with its fellow government agencies to try and figure out ways to kind of really crack down on this. So that's another thing that we're seeing. And then another big kind of trend is a promotion for voluntary self-disclosures, sometimes called VSDs. And that's because in the springtime, BIS published a policy memo kind of clarifying their stance, which very much was trying to promote more VSDs when there was a significant export controls. Even though I've broken these trends down as though there were 3 of them, I should point out that the way that we realistically interpret these is basically enforcement, enforcement, and enforcement. So that is very much what the government seems to be focused on. And given this kind of, I'll say, renewed focus and heightened focus on enforcement, it is definitely something that you want to be mindful of. And with that, that's really all I have for you today. If there are any other questions, I'm happy to entertain them and answer them. But before we go, I also just want to quickly say that here at Thompson Hine, we also have a blog, what we call the SmarTrade blog, where we routinely post news and updates in the field of international trade in general, let alone export controls. And I think that that's worth subscribing for. If recollection serves me correct, it's free, so you might as well. And if I can just kind of toot our own horn for a second, I find that other businesses, other law firms, especially that kind of have these types of blogs, they publish like once a month, but we are publishing every week. So we're very much got our ear to the ground and focusing on what's happening on a day-to-day basis. But with that, I'll leave it open to questions. And thank you so much for joining us today and learning more about export controls.
So we do have one question. Yeah.
Yeah.
So it was going back to some of the earlier questions that we had about sort of exports and re-exports or exports from other countries. It says, basically, is it correct that if a product from one country is using US technology and then exported to another country, or basically, will the license requirements apply? And I mean, Aaron, if you want me to, if you want to go ahead and jump in, go for it.
Yeah. So to that, I would say, the license requirements are, as the name suggests, they're always going to be a factor of your analysis. They're always going to apply. The question is kind of, are there certain exceptions that would enable you not to use it? So I would say yes, they would always apply. The fact that the item has US origin content certainly would, from my perspective, kind of put me on high alert that there's a strong possibility that they could, and I need to be mindful of that.
Yeah, and I think that, obviously throughout this presentation, you did a good job of basically simplifying export controls, but really it's not a simple analysis, right? Here, with if US technology is being used, there's going to be a couple different regulations that we're going to have to look at or analyze. The foreign direct product rule, which you mentioned, whether or not it is covered under the foreign direct product rule. That is, it is a foreign, it is a foreign-made product that is the direct result of U.S. technology, or if there's enough sufficient U.S. content in there to cover the de minimis rules, et cetera. It's the favorite lawyer answer of it depends, and it really does depend on sort of what's going on and how it's being made and how the technology is being used. We like to err on the side of caution in this area simply because of all the penalties you said. But it's again, the devil's in the details. I think that's all of our questions. I want to make sure that we hit them all. Yes, we did. Great. Well, I'd like to echo Aaron's sentiment and thank you all for joining today. For those of you who are looking to get CLE, the CLE's tracking code is TH1867. Again, just to be clear, the tracking code is TH1867. Again, thank you all for attending today, and thank you all for your interest. And this has been a fun, 4-part series. And I encourage everyone, if you haven't been able to see the other 3 parts, to go ahead and contact us, and we can get you those other sessions as well. Thanks again, and thanks, Aaron, and have a good rest of your day.
Thank you, everyone.